Think about the key drivers of the market. We got earnings, we have valuation, and we have money flow. And all of those would suggest the trajectory of the market would be modestly higher as we look out into 2019. And the thought process is as follows. We have third quarter earnings results right now. The first quarter, second quarter, each showed 25% year-over-year growth in earnings. This quarter will probably get similar type of earnings growth, but that's largely a benefit from the lower tax rates. So we look into 2019, we're looking closer to 7% year-over-year growth, which is still modest and sort of in line with the long-term averages. So that's your profile for earnings. With respect to valuation, we have valuation which is high. We can debate exactly how high it is relative to long-term history, but it's at the higher end of that, which suggests the pressure from higher rates is likely to cap any PE multiple expansion. So then you're left really with that earnings growth. And then you turn to money flow. And what's the story of money flow has been very powerful bid on the part of corporates buying in their stock. And if we look at 2019 for next year, this year we had 44% jump in the amount of cash spent on buybacks, and next year looking for about another 20% increase. So that's close to $1 trillion that we'll see and forecast that companies will be buying in stocks. So if you think about that, earnings, valuation, money flow would tell you that the broad trajectory of the market is a little bit higher.
Yep. So is it an echo of what we've said in prior quarters, and that is we get this drawdown, it's answered by a resumption of buybacks? Is that where we are?
Correct. And what we see is the average since 1928, so that's almost 100 years, the typical duration or period of time between a 5% drawdown is about 70 days, and we in fact had 69 days before the last drawdown. So it wasn't particularly unusual. Exactly what the timing or the catalyst would be, difficult always to predict, but it's not so unusual. The market has been basically sort of range bound, and our forecast remains 2850 at the end of this year.